you want to run by me again how you execute trades, the order of operation?
Yeah, order of operations. So my general order of operations is model it in O&E, then model it in TOS, and then once you've got sorry, let me get back on track there. So once you've got both O&E and TOS modeled, right? Nothing's executed or anything like that. Then go back to your O&E, execute, right? And then you go back to your TOS and you just do the best you can for execution. And then in the moment, right, as soon as you're done executing or as soon as you're kind of there, go back and look at your O&E and are you up or down from that moment? And if you're up or down from that moment, that will tell you like what your execution slippage was or something like that.
And so if I'm down in O&E, then I have made money on my execution because I got it for a cheaper price.
Typically, yes. But of course, you always want to, I mean, you can go into your actual execution logs in TOS or in whatever broker you're using and look at what price you got. And if you can look at that price, then you'll know, okay, what did I get it for versus what I executed it or for over in O&E or your analytics software.
And then do you update the trade log in O&E with the price that you actually got?
If you want the actuals, yeah, you can do that.
Okay.
I normally won't because I just, it's like, oh, that one I remember I got a little bad. But like I've always said, all of your executions kind of tend to wash out in the end, right? You'll get some that you'll get better fills on. You'll get others that you're not as good on, everything like that. I mean, it just washes out.
Well, and I assume it's more important when it's more critical when you're only looking for a very small profit target, where when the profit target you're looking for is bigger, then it's just not as big of a deal.
But at the same time that a lot of our trades end up dealing with that anyways, right? Because our more directional trades have larger profit targets for that reason, right? And then if you're in a really flat trade or like a very gamma neutral trade, that's when you've got to like kind of worry more about your overall like little small wins, right? That's a big deal. Okie doke. We still got a few more minutes, so anyways, yeah, rope. I executed the rope earlier in the day, and yeah, by the end of the day, that was a pretty big suppression with a lot of volatility that came in right at the end of the day.
I'm working on getting the link for someone.
Yeah, they can always go to our YouTube channel, and it'll always show it. But it would be nice to like send out just send out an email the instant we go live or something like that. That'd be a good little feature. You can make an email list.
Yep, I put it in the forum this morning also.
Theoretically, if they're subscribed to our channel, though, they will get notified when we go live.
All right. Do you want to? Well, I guess we have another minute, but shortly we can. I'm still getting emails in, so I'm.
Yeah, people are still getting used to this, this type of forum, I guess. Because I remember, I mean, typically on like a usual basis over there when I was running this over at Aramir, we'd probably have, 15 to 20. But I mean, it just
I think it's harder to find us the first time this way.
Right, exactly. So that's something that, I mean, Yeah. Once we start putting on regular videos and people are kind of used to the schedule and then things like that, it'll just kind of be like what it is.
Yep. Yep. All right. You want to start?
Sure. Fire away.
So, how do you define a recession? This person says, last time I was at the mall, it was packed. It didn't feel like a recession, which I have a counterpoint to that. When I was at Nordstrom a couple weeks ago on a Thursday, there were like 5 shoppers to the 25-ish salespeople. So that definitely felt scary, like a recession. But anyways, but
Yeah, I mean,
those are good definitions. So what?
well, yeah, in general, yeah, I kind of okay. So we're gonna go through. Definitely, I'd like to go through like first of all how I classify a recession, and just kind of like as a little talking moment here. I define a recession through a process, not necessarily like falling GDP or anything like that. But let's go through like the classical definition of a recession. And the classical definition of a recession is 2 quarters of back-to-back contracting GDP, which technically speaking, we had that in Q1 and Q2 of 2022, right? So that was a recession by like used to be normal standards, but now they kind of changed the definition of, well, you have to have that plus you have to have like rising unemployment. And what that ended up doing is it basically limited down how many recession or like what types of recessions and when did it actually happen. One thing to note about like the traditional definitions of a recession is that by the time they actually define it, a recession, the recession's over, right? So when you listen to like traditional economists or the news and they actually finally define like, oh yeah, we are in a recession, like it is pretty much like done and known that you're for sure in a recession. So typically while you're going through the recession or as the recession is developing, that's when everyone's like, is it really a recession? Is it going to be a problem? Are we kind of out of this yet or not? It's kind of like the opposite of the wall of worry in bull markets, right? Bull markets, you've got this wall of worry where it's like, no, we're still in the recession. It's all still going down. It's not going to work anymore. It's just over, right? And then in a bear market, you've got that, yeah, no, we're still in a bull market. We've got hope, right? You know, hope is the driving like force in normal recessions, right? So like if you ever just kind of want to put like, you know, an ear to the railroad and say, okay, are we in a recession or not? In general, what are people talking about? Are they still hoping for the market to rally? Then you're probably in a recession. If they're thinking that it's probably not going to rally anymore and you know the whole world is ending or something like that, then you're probably in a bull market, right? So that's one way to kind of go about it. But anyways, let's actually go through what the process is of a recession. And number one, well, here we have 4 stages of recessions, right? And this is how I define them, right? So this is particularly me. The first part is what's called deleveraging. And I'll kind of show you some graphs of this in just a second here, but the first part is deleveraging. The second part is demand destruction, right? The third part is collapse, right? That's normally when everyone's like finally saying like, oh no, we are in a recession, right? And then the final fourth part is the capitulation / stimulus, right? That's kind of the fourth and final. And then you end up cycling into a bull market, which is expansion and leveraging and all those. And anyways, we'll go through bull markets probably when we're in a bull market, when I'm getting questions about the bull market. So let's talk about each stage. And let me see if I can hear. I'll share a screen and we'll go through just kind of in general what deleveraging looks like. Okay, so where are we? Go into this one and then there we go. All right, so let's kind of talk about First, the first part of a recession is the deleveraging stage, right? The deleveraging stage, it can come in many different forms, and we're going to talk about a couple. These two. So this is, let me just zoom out here. All right, so this is the total assets at the Federal Reserve. The total assets at the Federal Reserve, this is basically like the Federal Reserve is either buying securities, right? You know, bonds, junk bonds, mortgage-backed securities, right? They're buying, or they're selling, or at least they're letting some roll off of their balance sheet. And this is a contraction in the money supply, right? So when the money supply starts to contract, right, that means that you no longer have the expansion of the money supply coming in, right? And when it goes from expanding to not expanding anymore, that's also a change in the market, and that can create a deleveraging as well, right? And the reason why this creates a deleveraging is because when there's new money coming in, think about anything that the Federal Reserve starts off as it just comes out of thin air, basically, because they're printing money, right? So they print money to buy assets, or they print money to buy things, right? And as soon as they just create new money, it's money that didn't have to come from someone's income. It didn't have to come from a loan somewhere. It didn't have to come from nothing. It just, boom, they just created it and bought these assets, right? And they gave money to whoever owned those assets. So what that does is it creates an expansion in the monetary system, right? In the financial system. Also, banks can do this as well, just regular banks. When we lower the reserve requirements, like what happened in COVID, right, where we lowered the reserve requirements basically down to zero. So it's basically you can infinitely loan out as long as you want. You don't have to have any reserves. So if you're familiar with fractional reserve banking, that's kind of what that is, where as soon as you take in $100, you can loan out 90, but you got to keep 10. Well, what this did, like during COVID, is they basically could take in $100 and loan back out that $100, but the original person still had claim to $100, but yet they loaned out the $100, right? Well, then that other $100 that got loaned out got deposited at another bank, right? And then they did the same thing, and so it creates this big expansion in the monetary supply. So you can see that in like M.2. I can probably pull up M.2 pretty quickly here. I normally have it. No, but I'll just pull up M.2 really quick. M2. So the M2 is the money supply, right? Or is the expansion contraction of money in the system. It's one way to measure it. There's actually other ways, but we'll just talk about M2 for now, because it'll be a little bit easier. Let me turn this to a log also. This will clean things up. And then let me zoom in here. And then one way that we can do this actually too is we can do percent change. And we can do from a year ago. That's a little bit easier. All right. So yeah, that's fine. So what you can see here is how much the money supply is either expanding or contracting. Another way to also look at this is, give me just a second here. Let me just go into here, and I've got a graph that actually I look at on a regular basis. That should be, yeah, M2. There you go. So this is M2 versus the consumer price index, right? So you can say, is the actual inflation rate, keeping up with the amount of monetary expansion, or is the money supply expanding faster than the inflation rate? If the money supply is inflating faster than the inflation rate, then typically what's happening is there is new money coming into the system, and there's actually more purchasing power coming into the system because there's more money coming in than there is needed to actually buy goods and services. But if you're having a contraction, right, where this is coming down and or the money supply is coming down, that means that the overall amount of money to buy goods and services is actually decreasing, right? So that's something to note. There's a few times in history that we'll just point out really quick because they're very similar to what we're kind of going through right now. But pre-1970, right? Before that recession, you had the money supply versus the consumer price index contract, right? Then you also had it in 1973 contract. You had it before the 1980 recession. And then finally, we had a technological revolution and we had inflation under control. And that's when we finally started to see a new expansion of the money supply. And we could finally get that going. And then we had a soft recession in 1990. And we'll talk about why that was soft and why this one's not so soft. And then, of course, you basically didn't have any issues here. And then this is when we started really printing money. And then we really printed money in COVID. And then, of course, we're doing basically what happened in 1975 right now, right? Now, this isn't turning up, right? So at the bottom of 1975, at the bottom of 1970, even in 1980s, right? The money supply started going up, right? That's that final stage that I was talking about in recessions, the fourth stage, which is that capitulation / stimulus. That's the expansion of the money supply, right? That's the final stage. That's when everything starts to really kick in and everything starts to improve again. And that's basically the first stage of the bull market as well. So that's the first way that we go about things is, are we deleveraging, right? Is the money supply contracting? Another way that they can do this is by raising they can raise the current yield or the current short-term yields in treasuries, right? And, they can do this a little bit on the far end of the yield curve as well, just to kind of know that that's what's kind of going on right now. So we're raising interest rates. As you raise interest rate, it makes money harder to get. And anytime that money starts to become harder to get or more expensive to have, you get basically like, just kind of think about it like a margin call. Say you're sitting there, say you're able to get money for 0%. And okay, great. That means I can invest in anything that gets me more than 0% return and make money on that, right? So if I get something that's 1%, and I've got 0% to get that money, I can go to the government, get money, or, you can go to a bank and get money for 0%. I'm just saying if it's 0, right? Then I can take that money and go invest it in whatever that endeavor is that only nets me 1%, and I can make a spread. So that's the expansion, right? So when we drop interest rates, that's kind of that trigger, like, oh, I can take on riskier and riskier investments that produce less and less and less yield, because the comparison, which is bonds, are basically netting out 0. So the risk-free rate goes down so low that you basically go into anything. Then the reverse happens, which is what we're dealing with right now. Now, all of a sudden, the risk-free rate starts to rise. And as the risk-free rate rises and rises and rises, those investments that you made that were only netting out 1% or 2% or even 3% are risky now, because they're netting out less than the risk-free rate. So you sell them and you push into the risk-free assets, right? Into bonds. And this is the natural flow of money. What's up, Michelle?
Oh, I just said,
Yeah. So anyway, so as we're going into that, that's the deleveraging cycle. The next cycle is the demand destruction. So as the cost of credit goes up, and or inflation rises to a point to where the general consumer is no longer willing to pay them, or their fixed expenses become so much that their real purchasing power for discretionary spending starts to drop. That starts to lead to slower business growth, right? So that's what we had a lot of last year. And we still have some of it now, right? You can see earnings are contracting. You can see revenues are slowing, right? I'm not saying that we're, in a deep diving 2008 type of crash environment right now, because we're definitely not. Now, will we go into that? It just depends on what kind of decisions are made. Right now, the Federal Reserve is erring on a lot more inflation. So basically, they're just erring on a lot more inflation. We'll deal with that in a little bit. But anyways, kind of going down that rabbit hole, we go into a deleveraging, right? That's when our deleveraging, and then demand destruction, that's the consumer side of things. And then once we go from the consumer side of things and the demand destruction, that's normally also when commodities start to dive. So like we can pull up like a commodities index. So like producers price commodity index, this should pull it up. Yeah, here we go. So you can see that you'll see commodities start to really dive down during that stage, right? So you can see that late stage 2022, you started to see the price of commodities, industrial commodities, start to drop. That's part of that demand destruction as well, right? And you see this in almost every recession, right? That you get a pretty nasty demand destruction. You can see that this is also most of the time right in the middle of your recession when this starts to drop down. It's the second stage. That's what I was talking about, right? And then the third stage comes in, which is the actual collapse stage. And this is when really the price of everything starts to drop, right? This is when you get either disinflation or deflation. You get commodities continuing to collapse, and then you end up getting a yield curve that starts to drop down. The whole yield curve starts to sink out. You can see this on here. So we can play this out through history, and this is so early on in a recession. We'll start off in like 2000, the dot-com recession, right? This is a common deflationary recession. So there's a deflationary recession and an inflationary recession. Today we're just talking about deflationary recessions, but because that's what's common in reserve currencies. So going down through this, right, you can see that the yield curve is rising. What's happening is inflation is spiking, right? Inflation's kind of going up. Everything's being driven up. And this is the Fed catching up to the yield curve, right? They're always behind the curve. They're still behind the curve. Anyways, eventually they will catch up to the curve, right? And the curve flattens out. Once the curve kind of flattens out and they get a fully inverted yield curve from front to back, that's the Fed either ahead of the curve or now behind the curve on the opposite side. In most cases, they're behind it on the opposite side. And then eventually, you can see as we kind of keep going forward in time, as the recession gets deeper, right, you start to get this collapse in the belly of the yield curve. And then the Fed starts to drop interest rates. And then eventually that brings down the risk-free rate. Once that risk-free rate starts dropping down, then it starts to incentivize people to actually invest in riskier assets again. And then eventually you start equities building and stuff like that. But you've got to get it down to the point where it starts to make sense and you have business growth coming in with it. Because do you want to invest in a company that's contracting at 10% annualized when the risk-free rate is at 2%? No. You want to get into a company that's growing at above your risk-free rate. So, hey, give me a company that's growing at 2%. Now I'll invest in it, right? And that's kind of how the banking system works and everything like that. Now, there's smart money that'll move into it beforehand and, traders. But as far as just the general flow of money, that's kind of what's happening. So now you've got this big drop. This is about halfway through the recession when the front end of the yield curve really drops down, right? And that stimulus is typically enough to start supporting stocks a little bit, right? You'll get these big rallies. You'll get these moments where like, oh, that was the bottom, guys. We're good. Of course, it's not over yet because you've got to go through stage 3 and stage 4, right? And stage 3, this is stage 3. This is the collapse stage. But you need to get to the actual capitulation / stimulus stage. And that's really where business growth really kind of flatlines, right? Bonds have finally bottomed out. They're no longer going down anymore. The attractiveness going into bonds is no longer there. Risk-free rates go down to 0, basically peg out. They're not going down anymore. And maybe you've got some quantitative easing or something like that. And that typically is the bottom. So you can see here, now that we've gotten down in here, bonds have finally stopped, or I should say their treasuries have finally stopped on the yield curve. And this is when you finally get kind of a bottom in the yield curve. You can see it stops out. And then now finally, you can see back here in black, this is the 1-year constant maturity rate. This is going to be what tracks closest to like the Federal Reserve target. It finally bottoms out, right? Then finally you get some money that goes into stocks, and then you get your final stage, right? And that goes into the bull market. So where are we right now, right? How do I, because I say pretty confidently that the recession is not over. So where are we right now? Well, this is where we were starting pre-recession. This is, say December or so, when I was like, hey guys, it's starting to look pretty nasty. A lot of you guys that have been following Awake and Sleep Well, nothing news, right? Now, once you get into a little bit deeper, you can see here now, I've fast forwarded to where we started to roll over, right? We have the deleveraging. This is the deleveraging stage, right? Stage 1. Then, as you finally get the yield curve getting up and the reserve, the Federal Reserve, right now where we're at right now, which we are almost fully inverted, right? The Federal Reserve is still catching up. They're not quite there yet, but they're catching up to the yield curve. Well, when they've caught up to the yield curve in previous recessions, and let's just kind of do that here. Let's look at 1974, right? When they finally caught up, that was halfway through the drop, right? Before that started to drop down, and then finally they were able to start dropping interest rates, right? So that was halfway through the drop. Let's go to .com. That was an inflationary recession, by the way. This is here's .com. This was a roll up. You're probably done. I think this is where they start dropping. Yeah. So you're a quarter of the way done through the recession in .com. In 2008, when they finally caught up, was literally like, I think right in the beginning of the recession. Yeah, right in the beginning of the recession. So right during the deleveraging stage, that was right when they finally caught up. So something to note about the last two recessions, .com and 2008. Those are deflationary recessions. Those are growth-led recessions where growth slows first, right? Right now, we have an inflationary-led recession, much like the 1970, 1974, and somewhat of the 1980s. Right now is much more closer to the 1974, where you get this high inflation. The Fed then has to catch up and try to create a recession. And basically in creating a recession, you create the demand destruction. That demand destruction slows down the business growth. The business growth creates the collapse stage. Then finally the Fed slows or stops or reverses like what they did in 1974. You can see that black line where they drop it halfway through the recession. Hopefully we're not going to go through that. So halfway through the recession, they drop interest rates and the whole market rallied. Right? The market got really excited and they go, yes, that's it. Everything started exploding, but then inflation also exploded with it. And it was like, nope, we're not done. And then they started raising interest rates again. And that's when we got the final like 30% push in 1974 is when they rose it back again. So in inflationary recessions, the Fed is the lever, right? They're creating the recession because they're trying to contract the money supply. In a deflationary growth-led recession, the businesses fold first, and then the central bank is kind of just reactionary with it. So they're a lot more closely linked to it. So anyway, so that's how we know that we're in a recession, is those four. Where are we at, right? We already had, just as I showed you in commodities, we've already started collapsing on that. So normally that's about halfway through these recessions. Let me kind of get back into like 1970s. Let me get into that. So these were huge high inflationary times, right? Huge inflationary times, which commodities exploded. We debased the US dollar. And that's what kind of happened in the 70s. So that was a whole whirlwind of craziness, right? So you can see here in 2000, our commodities dropped a little bit faster. They're dropping right now about halfway, or they dropped halfway in 2008. They're dropping right now. So where will that lead us? We'll see. Also, you can see where we are on a CPI basis. So where are we on CPI, right? Typically, most of the way through the recession, we've at least had CPI under control, right? And right now, we do not have CPI under control yet. we're still at 6.4. If you look at this on a month over month basis, especially if you look at shelter, we're still accelerating and gaining in many areas. And month over month, we actually gained a little bit in most of the places. So, that's something to keep in mind is like, what are we doing month over month? What are we doing year over year? So we're still battling this inflation thing, which means that the Fed still's got a little bit ways to go, and that will end up leading us deeper into the recession, even though we've had a little bit of excitement, because basically what happened was the Fed slowed down the amount of interest rate hikes that they were doing, which allowed the dollar to devalue. And by letting the dollar devalue, it basically created a little bit of inflation in the reserve currency, and that debased the currency just a little bit. And that's why like gold bounced. That's why bonds bounced. That's why stocks bounced. That's what's going to happen at the end of this recession when they debase the currency again, when they stimulate it. That's what happens to assets. That's why gold went through the roof in the 70s and 80s, right? When you debase the currency at the end of these inflationary recessions to spur growth again, it just explodes, right? And it explodes hard assets, including normally real estate, if the real estate isn't such debt driven. Right now it's debt driven, so it's a different animal. The last thing that I want to say on this is the contraction in banks, right? Bank tightening standards for commercial and industrial loans to small firms. This is also another way that you can tell kind of where you're in the recession. Typically, when stocks bottom out, like what they did in 2009, right? Banks are starting to ease up, right? They're starting to ease the reins just a little bit, and that ends up spurring that monetary base to expand again, right? And that's what can create new money coming into the system, new investments, growth, things like that, right? So if there's new money coming into the system and money's not being taken out, then you're typically near the end of the recession, if not the end. Right now, banks are actually tightening standards, and they're actually as high as they've ever been, all the way back to 2000. They've been in, COVID was way up here, right? That's a very bad situation. And then here you are in the 90s and stuff like that, right? So in 1994 and 5 was that soft landing that they did with high inflation. Remember that? That is why we had a soft landing, because you didn't have banks cranking up that lending standard, right? Hard landings are when banks are tightening things, because that means it's getting hard for anyone to get money and hard for anyone to grow, and it's making investments more expensive, and it's making it to where you can't take on risky endeavors. And risky endeavors typically generate growth. So that's where you also know in this as well. So instead of thinking as like a really easy way to define a recession, just think about it in steps, right? Number 1, deleverage. Number 2, demand destruction. Number 3, collapse, right? That's when you start seeing the bond yield curve start to collapse in. This is when you start to see disinflation or deflation in the CPI, right? Everything starts to really come down. You're not getting month over month acceleration in prices like what happened just on this last CPI print, right? That kind of stuff isn't happening anymore, and it's consistent, and the whole yield curve is reacting to that. Similar like what we just had, but it's going to stay that way, right? And the Fed will actually be dropping down with it, right? And then you've got the stimulus stage, and that's when you have government spending, which we just kind of had, which is part of the reason why this inflation is going to go longer and stronger. But the recession wasn't going to be quick and done. And that's why all the models are now projecting that we're going to have a recession later in the year. And now it's going to last a lot longer, but it's not going to be as deep. So that's what they're erring on the side. More inflation for longer, shallower recession, but slower growth for a longer period of time. Think like a lost decade or so. That's what they're doing now.
Gotcha. It sounds a little less scary if it's less deep and just spread out a little longer. I'm not sure if it pans out that way, but
yeah, I mean, as an investor that sees these things and kind of knows these things, if you've got a macro driven portfolio, you kind of want them to be quick, right? Maybe not as quick as COVID or anything like that, but I feel like they're less painful because you adapt really quick. You are in the right assets, right? You're in, you're at first, you're normally in the dollar. Second, you're into normally gold, bonds, and then inevitably you're back into stocks. And then now everything's growing again. So you can get that ebb and flow, right? You can kind of get that whoosh. When you get the just nothingness for years, it's hard to find growth anywhere, right? Because you just don't have anything growing. But the one thing that we are going to have is high inflation for longer, which is going to debase the reserve currency longer. So in general, what that's going to do is eventually the dollar will roll over and gold will go through the roof, right? And so you can go into hard assets like that or real estate. But real estate's going to have a problem. So land is probably going to be more so because it's not so debt driven.
Shall we switch over to some options topics?
Sure. What's the question?
Anything else you want to talk about first?
Well, this is also another thing, as far as where you're at in the recession, in general, just talking about real estate, you want real estate to be affordable for the buyers of that real estate. I'm not saying that the buyers right now are the general public, right? Because we've allowed a lot of institutional money into the single family home sector. But you definitely want this significantly more affordable. And right now we are lower than we even were in 2006 at the peak of the bubble back then, right? As far as an affordability metric. So things have to really shift a lot more for us to be done with this demand destruction phase, right? We really need shelter to roll over. That's a big component of the CPI. And I think, in general, most likely the Fed will continue kind of ratcheting this up. And what that also might do is if cap rates cap rates for real estate stay above what the risk-free rate is or what, AAA corporate bonds are, most likely it will drive institutional money out of single family homes again. And that would be nice for the regular public to be able to get affordable homes again. Because what you'll do is you'll sell your asset and then push into, AAA bonds and things like that. So.
Okay, so you've said that theta and other Greeks are theoretical and sometimes not helpful, which is putting it mildly to how you actually said it. Are second order Greeks even less helpful?
Okay. Wait a second here, because let me first, let me iron out Greeks as Greeks as like a barometer, especially certain types of Greeks are helpful. So like your Gamma Greek, your Delta Greek, right? If someone tells you, hey, I've got negative Delta right now. Okay. As soon as I hear negative Delta, I know it's a bearish trade, right? So that's a helpful Greek, right? Hey, I've got positive Gamma. Okay, great. So that means that you're most likely a net buyer of time premium right now, right? So that's something, right? Like I know those types of things. So Greeks are helpful in that sense. As far as theta goes, it depends on your structure if theta matters, right? And then also it's your balance that really matters. So what I mean by that is like, let's say, I mean, I know a lot of our trades, and I've shown this example a lot of times, but like here, wonder if I could. Yeah, let me go. I'll go into like back tests, and I'll just go to a random time. Something that. Sure, we'll go into this time. That'll be okay. All right, so
I remember when I first started looking into options, I definitely thought theta meant if you have 50 days to expiration and you have 100 theta, I better be getting my $2 a day, because that's what that says. To find out very
Right.
fast, that is not what that means. That is not a guarantee. In fact, you can lose $40 the next day instead of getting your two.
And that's actually something that, like, yeah, in general, let's just kind of talk about the concept of theta. And let me make sure I've got you on the right screen. So in general, let's just kind of talk about theta, right? So I'm just going to draw a little graph on here. So say this is 0 days down here. This is DTE, right? And then this is your let's just call it your value, right? Or your the dollar amount in your option. So let's kind of in general, as humans, we think of this line as linear, right? And so like, hey, look, I'm out here at let's say it's 50 days, right? And this should tick down at, let's say, like $500, right? Say $500 a day. Like I should be making $500 a day, right? Like that's theta, right? That's definitely not how it works, right? Now let's talk about this other element on here, which is what's called the square root of time. So there's kind of this funky thing that we do, which is we put heavier weight on closer decay than we do on further rated decay. It's normally contango, things like that. A lot of people measure contango with volatility, which is totally wrong, but it's okay. So anyways, in general, let's just kind of put the slope out here and just imagine it like this, where a lot of your decay accelerates significantly further in the last portions, especially on the last day or so of your option, and it significantly decays slower further out in time, right? Not all options are created equal. Some of them have a decay curve like this, by the way. So not all options are created equal. Know that. So what we're going to talk about here, though, is this theta, like, why does this theta not matter? Well, in general, most options analytics software will assume something like square root of time, right? Whereas this decay curve will change depending on market environments, right? Market environments that are part of our proprietary metrics, but still, that's something to note. Like, where and what is going on with that options decay curve? Where is it at? Why is it changing? Things like that. What variables affect that? And if you can think about this like in a slightly different situation, let's go with this same graph here. What can happen is you have this decay curve, right? And then you have a like an event in the market, or a shift in the market, or a change in the environment. And all of a sudden, this decay curve shows up and ends up looking like this, right? What starts to happen, right? Remember, this is the price of your option, and this is time, right? And this is 0, and this is 50, right? If you were to sell an option right here, and that event happens, and it drops all the way down here, right? What happened? Well, it was just like you fast forwarding, right? Like 10 days.
Mm-hmm.
So it's not the theta per se, but it's a lot of environmental factors that drive the price of the actual option itself. And to try to simplify it down into a simple, it's theta, is not a great situation. Also, theta at the money is irrelevant if you're not going to be there to capture it. Right.
Mm-hmm.
So let's talk about that, which I mean, this is probably what I drill down on the most. And I'll shift you guys over to that screen here.
It's the idea of, if all else stays the same, then this is how it will go. Well, that's nice, but that world doesn't exist. All
Right,
else never
exactly.
stays the same. It's imaginary.
Exactly. And that's exactly the whole point behind this. And I mean, let's just say, I mean, here, I'm literally, I grabbed a random date on here, that at least I know that we're going to have a little bit of accelerated decay, most likely. I mean, I'm not quite sure because I literally just grabbed this date. But let's just say that you've got this trade on here, right? If the market stays here, then absolutely this trade is going to be phenomenal, right? Because you're going to have, it says 13,300 or $1,337, right? And so let's see if that's true, right? Just $1,300 a day, right? Let me just turn this into a trade. And let's just see what happens over the next few days. Hopefully the market is nice to me and doesn't just rip away. But that might also drive my point yet again. Theta is irrelevant if the market doesn't stay where it's at. But let's see if we can get back to our single spot. I don't know if we were going to. Let me look at the chart. Where are we at? I don't know. We'll see if we can get back there. We'll just kind of let this thing run risk-wise. So we've been in this trade for, first of all, we've been in this trade for 1, 2, 3, 4, 5, 6 days, right? That means over probably a weekend as well. So 6 trading days, and we are down, $1,243. Okay, well then it's like, okay, well wait a second though, you had delta, right? Okay, so let's normalize our Greeks here. Let's go back to the 17th or so. I think that's what I grabbed. So let's normalize our delta, right? And so, some ways that people normalize their delta is they bring back this upper thing. Now we're basically at 35 delta, right? Let's just keep it here. So now we've got flat delta, and we've got $1,000 in theta. So let's see if we made $1,000 tomorrow. Did we make $1,000? No,
not so much.
Well, our gamma was not, crazy high or anything like that. But let's say it was delta. So let's normalize it again. That's going to be too much. So let's just boom. Now, that's not enough. Negative 30, 30. There we go. That's probably pretty close. Okay. So now we've normalized delta again. Next day. Okay, we've sat still. So this is really interesting, right? This is a great day, right? Because here we go. We've got 1,100 in theta. The very next day, we go nowhere. And did we make any money? It was like, nope. What happened here?
Yeah.
Right. We literally we didn't get any. We didn't get all that theta that we were looking for. Like, what happened, right? So this is what I'm just going to dig down into a little bit more, is what I care about, right? And I mean, now we know the future right now, but because we fast forwarded a couple of days, but let's go back to the 17th. And this is the importance of having, oops, it's going to tell me all sorts of freaky things because I went too far. So what I care about, I mean, we're totally synthesizing this because we know the future by 6 days because I just fast forwarded 6 days. But in general, what matters the most is to skate where the puck is going to go, right? Wayne Gretzky. So we know the market's going to go up, right? Our theta right now is negative 44, right? I mean, do we care about theta? No, because our delta is the most. Okay, fine. Let's get rid of our delta. Oops. All right. Now we have basically no delta, right? So now it's not going to be delta that's driving anything. All right, let's do what we did with the other trade. And now let's see how this trade works. Now, first of all, I only had $200 in theta and I had no delta. And I'm up $6,600. And I had no delta, right? No Greek in there would have made up for that. Okay, except what? Maybe volatility, right? Okay, let's look at what happened to volatility. Did implied volatility drop? Absolutely, volatility dropped. Vega is my largest number, right? Vega is always the largest number for all of our trades, right? Almost always, because that's what's creating so much extrinsic value if you're trying to sell time premium, right? So that's probably the one Greek that I would look at the most. But watch out for how it's calculated. It's calculated for Vega where the market is, right? Not for the Vega of where the market is going to be. So if you can start kind of making our trades to where it's like, okay, what's likely going to happen? And I'm not even saying predict the future, right? I'm just saying that set yourself up in a position that you can stack a bunch of probabilities, figure out what your macros are, figure out what, just general technical analysis, whatever you want, right? To determine what your ranges are going to be. Instead of just slapping on some willy-nilly trade that's quote unquote positive theta, is it positive theta for what the market's throwing at you, right? Are you in a raging bull market with macros expanding, a Fed printing money like a crazy man, accelerating business growth year over year at breakneck speed, and a monetary system exploding with government spending going through the roof? If you're in an environment like that and you're not putting your structures to the upside of the market, you are at a severe disadvantage. And if you're just putting regular theta trades on and hoping that your theta will come into the market, then you're also putting yourself at a disadvantage. And what you'll see with a lot of those types of trades is then what you have to do is you have to heavily aggressively push into delta to make up for the fact that you're in the wrong position, right? You're in a position that just doesn't matter anymore. And even though this is negative delta right now, I mean, this thing will probably still do just fine on its way up unless we get some sort of explosive move, right? And it's cruising along, it's doing its thing. And it's because we're up here where the market is more likely to be, or it's going right now. Like I said, we did fast forward a few days. And now we're pushing quite a bit of heavy negative delta. Let me fix this. So, let me fix this guy and then go to your next day. And then, okay, market's going up, right? Everything's driving up. And this is where our theta is, right? So now negative 20. I'm getting a lot of gamma in this trade. I mean, I'm just kind of willy-nilly like throwing this together. But we also, like I said, we also know the future right now. But if you've got your trade up here, you're not fighting with things. You're not using heavy aggressive delta. I knew that we were going to run into this and it's fine. I'll talk about that another day. So the whole concept of theta in general, I mean, even then you can kind of see we've been holding this trade with a lot of theta up here for a while, and it still wasn't coming in perfectly, right? So Vega was a much bigger driver of things. Where your position is a much bigger driver of things. Your delta is a very large driver, but watch out with how your delta is, kind of calculated and how it's how it's dealing with. I know that there's a lot of things that our members have talked about because like we'll switch over to calendars sometimes if the market is conducive to them, and you'll have a certain amount of delta, like it'll be flat delta, and it'll basically show negative theta, and then all of a sudden the next day you're up 40%, and you're like, what? And it's because of the environment shift that's driving the price of those options, not necessarily the theta or the Vega, right? Because a lot of the times in those environments, you're negative or you're positive Vega in a calendar, supposedly, but you get a big Vega drop and you make a bunch of money. And it's like, yeah, well, it depends on where the Vega is priced in at most on that options structure, right? whether it's on your short, whether it's on your long, how it gets pulled out when you have an event or when you have a Vega drop, right? And that's part of that that shift that I was talking to you about, and that's part of that environment that you got to look at. So in general, that's the big thing, the thing to take away. Beware, make sure your future structure is where the market system is going to go. Make sure you're in the right structure, right? Our metric says that, but make sure you're, and we tell you, it's shared with all of our members that it's like, hey, yeah, you need to be in maybe a butterfly structure. You need to be in a calendar structure. You need to be in an ATM or an OTM, or here, these are the types of stretch adjustments that you can have, those types of things, because that's really what's important in that environment. A vertical in one environment and a vertical in another environment act two totally different ways, right? Try to trade a vertical behind the market in late 2021, right? You're going to have a problem. So
we have a question from Dave. Hi, Dave. With Adapt Advanced, will we need to monitor trades throughout the day?
Okay, so if you're pushed close to expiration, right? Adapt Advanced, if you're in some environments, we're pushed really close to expiration, or your trade has started to drift really close to expiration. It's not a bad idea to monitor them. As far as how, like, I'll run mine, which I'll put up on a daily basis, like what my trades look like. I'll make those to where, in general, I'm not going to look at them every day, and I'll tell you if I'm starting to watch them intraday, right? So it just depends on how close to expiration you are. If you're having to use a 1 hour chart or a 4 hour chart, it's probably a good idea to at least look at that interval, right? Just at least check in on your trade. You don't have to do anything with it. You don't have to do something nuts, but just kind of, prepare in advance the night before. Hey, if this happens and it's way up here, what do I need to do, right? So that way you could make a quick adjustment. But in general, I'll make my trades to where they don't have to do that. And you'll know in advance if we're starting to get down to that. And we are probably many years away from being in a situation where we could be that close as well, by the way.
That's at least kind of handy.
Yeah.
And then we have some other questions that we're not going to get to this time, but let's make sure we get to how to trade these complex structures with small size.
Oh, okay. Yeah. All right. So let's just set up one. Here, we'll go to, okay. Yeah. We'll go to a rope trade. So we recently had a rope trade for our daily advanced, and let me do this the short way. Go to 2023 February, and we'll go on the okay. So let's just set up a small trade right now. Hopefully this will let me do it. I don't know if the 10th is going to be good enough. All right, so I'm going to be on, let's just go, I got more strikes on the 28th. I'm supposed to be somewhere around this 30 DTE, but let's just go to this guy. So, and I'm going to use as small as humanly possible. So I'm just going to go down to a single contract. Excuse my fingers. I'm used to putting in triple digits. So let me. All right. So in general, those of you guys that have followed my systems or anything like that, you guys know how I size flies. And that goes back to being dynamic with the market, right? Being dynamic with what the market is pricing in. I'm not going to go into that right now, but know that in general, this is the maximum fly size that you kind of want to have. Now, the reason why you don't want to go any further is because once you start going further beyond this, you start to just increase capital at a rate at which is really not conducive for you, because you're just adding more capital, but you're not getting necessarily more bang for your buck. One way to think about this is like, here's a vertical, right? I'm going to get, let's call it $3,600 for this vertical, and this thing cost me, let's just kind of look at here. I'm going to get 51% return on this, right? Now, if I make this thing huge, I'm getting a 31% return, right? Now I'm getting still a 24% return, right? I'm adding my cost, right? This is a $33,000 trade, and I'm actually getting less return per that spread, right? And then as you go closer, let's call it 43, 50, 58, 65. You can see how it's stretching up bigger and bigger and bigger on the amount of credit that you're willing to get. But then you also notice that you don't have any theta on your, theta. We just talked about theta, right? But I'm just using it just in general, right? You don't have any theta on your system because your spread is where it is, right? So there's a balancing act of the cost of your returns per the amount of decay that you're going to get, or the maturation on your spread, versus how much it costs to execute them. I like to err on the larger side of my flies, because it means I have less contracts to deal with, right? Less contracts means less commissions, which means more efficient trades, which when you start to trade 500 butterflies, you've got to deal with, that's a lot of structures that you're dealing with, right? And the least amount of contracts that you got to send into the market, the less slippage you're going to deal with, all of that, right? It's all good things. But when you're a smaller trader, you don't have to really worry about those types of things. So going smaller is not necessarily a bad thing, but in general, I wouldn't go 75%, lower than 75% of the original width. And the reason why that is because it starts to not decay according to the original parameters, right, of most of our trades, right? You start to get a little bit less gamma than you were intended, but let's just kind of start showing what I'm talking about here. So we'll commit this guy, and we'll just throw it in something, right? So we'll throw this guy in here, and then let's do something that's half the size, and we'll separate these two out. So here's a half the size butterfly right here, and you notice that it's really not going to be the same. So let's add the same amount of capital in here. Gonna need more. All right, we're almost at the same capital, right? But as you notice, though, our T+0 line and our double line are still almost identical, right? So this is where contracting yourself down from the maximum really doesn't have a huge net effect on the performance of the trade. Now, something that I've always had an issue with, that I've been relatively vocal about, is if you have anchor points on your trade of hey, above this long strike, I start to trade my trade differently than below that long strike, and you're not being dynamic to the market with what the market environment is, you can start running into issues inevitably as the asset grows in size or shrinks in size and all that kinds of things. So just know that that's a thing. So, but the net effect I want you just to see here, that going into a smaller fly doesn't really change too much. Yes, it changes a little bit, and it really doesn't start showing up until you get really deep into the trade, right? Until we're really close to expiration, you can start to see that these lines start to really separate, right? And that peakiness starts to really show up, and those outer legs start to really contract in. And that net effect, if we're pushing on certain edges, that's why I say don't go underneath, roughly 75%. If you want to go to 50, that's still probably the maximum I'd push it. But then let's start to push this even further, right? If we push this all the way down, and let's just, push this to an extreme, because that's what I like to do. I like to push things to an extreme to see if they break. And let's put in like, this is probably going to take, let's say 25 flies. Yeah, there we go. So we're about 25 flies. Now you can start seeing that there's a pretty big difference on these two T+0 lines at the end, right? And let me just do a second projection line, and then we'll just do one projection line, and then we'll go like way down here at like 24, right? So you can see that there's a pretty large difference in the performance characteristics up here in front of the structure and even down here behind the structure. And that's because you've got a wider spread width. That wider one is actually going to perform better, right? So keep that in mind. That's why I say don't neck down too small. Then also at the same time, but this is the point of this. You see that I'm having to use a lot more contracts to get to the same amount of power, right, of the trade. And that's because I'm normalizing capital right now. So what we can do is we can use that to our advantage. And this is just a butterfly, right? Calendars are a totally different animal. We'll talk about calendars as well. But so let's just say that I need to hedge this guy off and get this down to 0 delta, right? Well, if I put another equal size fly here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Okay. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, negative 2, 3, 4, 5, 6, 7, 8, 9. Okay. So, and then we'll combine these guys. So let's just say I want to put this trade on, right? Like that's my goal. I want flat delta. Well, this is too much. And I can't shrink any more contracts, right? Because it's a single contract, right? Well, remember what I said about being able to shrink that butterfly and it becoming less powerful, right? Acting like it's less flies. So we're going to use that to our advantage. So let's contract this butterfly by even amounts on both sides, right? And it'll still keep our trade even. And now you're seeing this front butterfly now has less power to push that delta. So now let's bring it down even more, right? So now we're down here to 0 delta, which was my original intent, was to get down to 0 delta on this trade. And I did this with a single contract in both directions. If I wanted to be even smaller, we can go to the smallest we can get while still staying on the SPX. And we know that we're generally going to stay around the money. We know that we can get a little bit smaller than the original size. So here's our original size, or here's smaller than our original size. And then we also needed to set up a smaller trade in front of it. Now, with our trades in Adapt, because we have certain sizing and like especially if you've got, like I said, an exit based on an anchor point. Like for instance, our rope trade, one set of rules in our rope trade is where you've got to exit above the front crossover of the upper butterfly, right? Or let's say there's some trades where you exit out of the back of the butterfly, like the lantern trade, right? Make sure that you're looking at the full size spread to dictate whether you're out the back of a butterfly, right? Because imagine that we're in a little 30-point spread here or something like that. You can see in a single day, we blew out the back side of this butterfly, right? I mean, like, come on, that's way too small for what the market's doing right now. Like, that's just a ridiculous. Push it to an extreme. What if we had 10-point butterflies? Intraday, we blew out the backside of that butterfly, and that would have called for an exit, right? Like, no. So look at so what I would do, and what I've done in the past is when I've got a smaller trade on, what I'll first do is let's go to this custom trade that we just made. And we'll go to separate, right? So this is the bigger trade back here, right? I'll leave this trade on. Like I'll run this trade and I'll call it the proxy trade. and then I'll trade a smaller trade. That's what's actually reflected in my account because I'm trading smaller. But my rules are dictated by the bigger modeled trade, right? The proxy trade in O&E. And that way I don't deviate from trade plans or anything like that, right? And I know that am I performing in line with the bigger trade and things like that, right? So that's something to note, right? You can shrink this. Now, also, if you need like a call or a put, right, you can always throw that on the SPY if you're on the SPX, right? And so that's a lot easier. That hopefully doesn't need too much explaining, but they're 1/10 of the size. So if you put the same vertical on in the SPY, it's going to cost you 1/10, right? But know that it's also going to have 1/10 of the delta. In O&E, what you can do is trade 10 times the size of what your trade is at your broker, and then just make sure that you're dividing all your numbers by 10, and that's what you're actually looking at. If you're using verticals in SPY because you've got a short on there, beware of being exercised. So my personal preference is that if I'm trading smaller, I'd rather put a vertical on, like a smaller vertical in SPX rather than going to the SPY. If I'm going long, I don't care. I'll throw that on the SPY all day because I don't have any exercise risk because I'm the holder of the option, right? So something like that. Then now calendars are a totally different story though. So let's deal with a calendar.
Can you hold on one second? The biggest question is with that front fly for the rope trade. If they have to put on a front fly, how do they size that smaller? So if they're just going to do one standard size big fly, what do they do with that little call fly up above?
Yeah, and I thought that we went through that. So let's go through that one more time. So let's say that the front fly. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. I have 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Okay, so here's that front fly. Like we were saying, let's just say this is the same thing with the rope trade, except I'm just using different rules right now, so I don't have to go to a different date. But let's just say I need to get down to 0 delta, right? Or maybe I need to get down to a theta delta number of like 50 or something like that. Something. But I can't get smaller than this butterfly. Remember, we shrink this down. We shrink this butterfly evenly, right? We shrink this butterfly evenly.
You shrink it, leaving the shorts where the shorts belong.
Always, because if you move the shorts from where they are, you're then bringing your theta kind of closer in, and you're bringing things into where the original structure is. And so you're going to really kind of offset it. There's already going to be a little bit of discrepancy in your performance by just doing this because you're getting a little bit smaller, but it's normally pretty insignificant as long as you're not shrinking this fly to like some, crazy number, like 1 or 2 or something like that. But yeah, I mean, you can shrink this guy all the way down to like this very easily and get yourself down to, like a 25 theta delta. And this is a perfectly fine trade, and it will still decay and match very appropriately to how if we commit this guy to how like a rope trade would decay. You can see that the total bump is going to be relatively near where we expect it to be. Everything's going to kind of behave the same. So just to kind of prove this point here, let's put on.
So the order of operations is to get the bigger fly how you want it, then put on the upper fly in the full size, which now is going to be way too powerful. Then from there, bring the longs in, keeping the shorts where they are. Bring the longs in until it is the appropriate strength. Right?
Right.
Isn't that what you taught me, boss?
Yeah. That's exactly it. So just kind of, I'm going to make sure these are separate. And the other custom trade was 25 theta delta. So I'm pretty close, right? I'm 22, but I'm pretty close, right? You can see here my theta is, roughly 10 times the size. So in general, if you're looking at, quote unquote, the Greeks, you can see that I'm roughly, 10 times the size because I've got 10 flies back here. But remember, I shrunk that front butterfly versus using less butterflies as a whole on the front, right? These are the two different trades. So now if we, don't commit this in this one. If I commit this into a different, trade, and we fast forward to, a couple days from now, so here's the 14th, right? And so here's a couple days from now. There's that theta that's garbage, by the way. So if we go to a couple days from now, we're up 9%, roughly speaking, on the full size, quote unquote, full size trade. Let's go check what our small trade is performed like. You see what I mean? Like they're getting pretty close to where they are. And that's all you care about. And we're actually outperforming on this trade just a little bit. And that's fine. And it's because you're using smaller contracts. And it was yet again, I was going back to the efficiency on capital is actually aired a little bit inside of where we size our flies in most environments. But I prefer to go to the larger fly as much as possible because, like I said, it keeps contracts low. And it's going to matter with how we size flies when we're in a low volatility environment or something like that, or if we're pushed really close to expiration, right? If we're at 14 days or 10 days and you're trying to put on a butterfly, and trust me, we're not going to be asking about, hey, how do I trade this thing smaller? We're going to be sitting there going like, holy crap, this is so many contracts I've got to put in, right? That's why contract volume starts to slow down in higher volatility regimes. Just even in the SPX.
Sorry, we got a question about don't you use the call side? They act the same. The call side feels easier, right? And the spreads are better.
Yeah. I'm showing this just on back trader O&E. My preference is to use the call side, yes, because they're going to fill easier. There's more volume up on the call side because those are the out of the monies up there. So yeah, I would use the call side. If I'm above the money, right? Keep in mind, if I'm above the money and I'm selling premium above the money, I'll use the call side. If I'm below the money or at the money, I'll use the put side.
Excellent.
This is for demonstration purposes only. Right here, right? So, calendars, right? Okay, so that's our next step is calendars. Let me just kind of crush through calendars really quick. Calendars are a little bit more difficult. I'm just going to pre-warn you guys on calendars because they're not as easily malleable as shrinking the fly size. But let's say that we've got... Also, it takes more contracts to get a single calendar, like to get the power of a calendar on, which is kind of a bonus as well. So let's just say we're up here at... And let me go into a new trade. All right. So here's a relatively an even calendar, right? 48-48, right? So let's just say I'm trying to offset let's say I'm trying to offset a trade with this. Here, we'll do it like this. Okay, so let's say that I'm trying to offset the delta of this trade with a calendar up here, right? Well, that's all fine and dandy if I've got the contracts here to do this. So let's say I need to lift it. I can just add contracts on this, right? So that's how I would do it if I can handle full size. But what if I'm using one contract? And that calendar is way too strong. Like, let's say I need some more negative delta on this. How do I deal with that, right? I can't move it, right? Because that's not per rules most of the time. Because if I start moving it, I start to really mess with like where I'm grabbing an edge on. So instead of moving it, what we can do, just like a vertical spread, right? If we can imagine a vertical spread is going up and down the chain, right? By shrinking or expanding a vertical spread, we can get the same amount of power, right? On a calendar, we can shrink the horizontal spread, which is what a calendar is. So instead of it being out here at 13, we can shrink it down to being here at 10, right? And now instead of adding more contracts or subtracting more contracts, I was able to get more negative delta on here by shrinking the horizontal spread, right? Because that's what a calendar is. So just think about like 2 dimensions, right? Like a chessboard, right? A vertical is front and back, and a calendar is left and right, right? So I can move a contract up and down on a vertical basis, and that's what a vertical is, right? Or I can change it on a horizontal basis, which is through time on a calendar basis, and that can shrink the amount of that can shrink the power it has, and it can shrink the amount of power, or it can shrink the amount of contracts I needed, things like that, right? Or I can increase the amount of contracts I need if I make the calendar spread bigger. Just know with what's up?
Sorry, I couldn't quite see what you did. Did you squish them closer together, or did you pick them both up and move them into closer DTEs?
No, I left the short where it was in its primary DTE up here, right? And all I did was move the long closer to the DTE. So I was at 13, now I'm at 10. Let's say I wanted more negative delta, so I delete it out of the 10, right? And then I push it into the 9, and now I get even more negative delta. Say I want to go even further, I can push it into this one, right? So that's as maximum as I get, because I think that's an AM on the 9th. But now that's the smallest spread I can get, right? I can't get any smaller than that. If I need to get any smaller than that, there's very limited things I can do with it. If I needed more delta, then now you've got to start, like from this point, now you've got to start making your fly a little bit bigger. So then you can start increasing it this way. I don't know if that helps with capital, but that would be the other way that you can kind of do it. So just kind of manipulating those variables of like either making your fly bigger makes it more powerful, making it smaller makes it weaker, and then making your calendar either bigger, right, like horizontally, right? You can go further out in time to increase its power, or you can go closer in time to decrease its power. Something to note, though, right, on our trading systems is that if you go too far, right, like I said, about 75% of the spread width, or even 75% of the horizontal spread width, you start to push it to where it starts to behave just a little bit differently, right? I definitely would not go smaller than 50% of the original fly size if I can help it, right? Otherwise, know that you do run the risk of it slightly being, it might not acting exactly the same. And calendars are more sensitive than butterflies. You can get pretty small with a butterfly and really not affect it too much. But a calendar, if you go to like a 1-day spread versus a 10-day spread, it's going to be a pretty dramatic change on how it's going to behave.
Okay. Any more questions, guys, on that? And then we'll get to some other questions next week too. It looks like that's it.
Sweet. Well, I'm glad that we got to cover those things, because I know those are things that got asked, and we went through a little bit of the macros. And what are the things we're going to cover next time?
The theta delta ratio that we ask for in some of our different trades, if they're going to err on the high side or the low side, which is preferred, and what's the ramification of that. I think that's the biggest one. The question about second order Greeks, whether those are of any use or not, we could circle back to as well.
Okay. Yeah, sounds good. I mean, I think the next one's going to be fun too. And I mean, we'll see what we end up going through.
I'm sure we'll have more questions by then as well.
We do have a lot that get emailed to us. So yeah, whether we use them here or not. So anyways, I think it's great that we got some participation this time around, and we'll make sure that these are a little bit more visible. And if you guys have any ideas of like how to publicize this a little bit more, get it to some of the other people that are asking questions. Let us know, because I don't know how visible it is.
All right, we'll see you next time.